Thinking about using a wrap note to sell a property, but you still have a traditional bank loan in place? Hold up, there's something you really need to know before you do. A wrap note or a wraparound mortgage is a type of seller financing where you, as the seller, finance the property to a buyer, but you still owe money on the original mortgage. The buyer pays you and you continue to make payments to the bank. Sounds great, right? Not so fast. Here's the catch. If you have a traditional bank loan, there's almost always a due on sale clause in the loan documents. That clause gives the bank the right to demand the full balance of the loan immediately if you sell or transfer ownership of the property. So, if you do a wrap and the bank finds out, they could call the note due. If you can't pay it off instantly, they could start foreclosure even if you've been making payments on time. And yes, your buyer could lose the home. Now, in practice, a lot of banks don't call the note due as long as they're getting paid, but that doesn't mean they won't. The risk is always there. You're gambling with your buyer's home, your reputation, and potentially a lawsuit. So what do you do if you still want to structure a wrap? Well, first of all, get written permission from the bank. Hard to get, but it's the safest. Number 2, be fully transparent with your buyer about the risk. And number 3, always use a real estate attorney. Wrap notes work great when your underlying financing is private. In those cases, you're not dealing with the due on sale clause. So yes, you can use a wrap with a bank loan, but should you? Only if you're ready for the risk or have permission in writing. If you're thinking about using creative financing, make sure you know the rules before you play the game. Now go and create some true passive income today.